Hello students, this video lecture is an initiative taken by Shet Vidya Mandir Junior College of Commerce, and this video lecture is for 12th standard SP students, and our today's topic is Annual Depository Receipt, that is ADR, Global Depository Receipts, that is GDR, and Trade Credit. Students, in India, the shares of public company are listed and traded on various stock exchanges, mostly popular Bombay Stock Exchange and National Stock Exchange. These are the place, or you can say it is a market where buying and selling of shares and securities are being traded. With adoption of free economic policy in 1991 and due to globalization, some of the companies in India listed their shares and traded it on foreign stock exchange. The foreign exchange like New York Stock Exchange or a National Association of Securities Dealer Automated Quotation. In short, to list the shares on this foreign stock exchange, the company has to follow foreign policies created by the stock exchanges. The policies of the stock exchanges are different than the policies of Indian Stock Exchange. Therefore, those Indian companies which cannot list their shares directly on foreign stock exchanges get listed indirectly using ADR and GDR. These are the instruments called as depository receipts. ADR and GDR are dollar euro denominated instrument traded in USA and Europe stock exchanges. Indian company issues shares to an intermediary, that is an agent called depository. Bank of New York and Bank of Citigroup etc. act as a foreign depository bank, that is an agent, a agent between the investor and the Indian companies. This depository bank issues ADR and GDR to the foreign investors against these shares. In this way, the foreign investors are investing in Indian companies, or you can say are investing in equity shares of Indian companies by buying ADR and GDR, that is depository receipts. The ADR and GDR represent fixed number of shares. It can be 30, 20, 10, 50, 40, etc. This ADR and GDR are then sold to the people in foreign country. The ADR and GDR are traded like regular shares. They are listed on stock exchange and the prices fluctuates depending on demand and supply. Likewise, even here the market value is fluctuating depending on the demand and supply and performance of the company. Both ADR and GDR are depository receipts, but only difference is the location where they are traded. If the depository receipt is traded in USA, it is called as American depository receipt, and if it is traded in a country other than USA is called as global depository receipt. Non-resident Indians, that is NRI, and foreign national can invest their money in India by buying ADR and GDR. They can buy ADR and GDR using the regular equity. The company also pays dividend in home currency to the depository bank, and the depository bank converts it into the currency of investors and pays dividend. Suppose if your company is listed in New York Stock Exchange, and after a year, or you can say at the end of the year, when you distribute or you declare a dividend, you will transfer the amount of dividend in rupees INR, rupees, rupee. And this depository bank, they will convert this Indian rupee into dollar for ADR and even into European currencies for GDR. The exchanges on which GDR, that is Global Depository Receipt, is traded are as follows: London Stock Exchange, Luxembourg Stock Exchange, Nasdaq Dubai, Singapore Stock Exchange, Hong Kong Stock Exchange. Our next concept is trade credit. Students, no business can be run without credit. Credit is the soul of business. Trade credit financing is a major source of short term financing. Manufacturers, wholesalers, and suppliers of goods or materials are called trade creditors. They sell tangible goods to other business concerns on the basis of deferred payment, that is, future payment or postponed payment. Credit is extended by the business concerns with an intention to increase their sales. The business firm extend credit also because of custom or tradition that has been built up over time. Trade credit is not a cash loan. It results from a credit sale of goods or services, which has to be paid at future date after the sale takes place. In other words, when goods are delivered by a supplier to a customer and the payment is made after some time, it is called as trade credit. In distributive trade, this kind of credit has great significance. The small retailers, to a large extent, rely on obtaining trade credit from suppliers. It is an easy kind of credit which can be obtained without signing any debt instrument. It is readily available and is cheap method of financing. Supplier sell goods and willingly allow 30 days or more for bill to be paid. They even offer discount if the bills are cleared within a short period, such as 10 days or 15 days. The terms of credit are not rigid. It totally depends on the relation of two parties, buyer and seller.